you're 55 and older and you've saved most of your retirement savings in pre-tax accounts like 401ks or IRAs, here's a hard truth. You don't really own all of that money. You have a silent partner in your retirement. That is the IRS. Every dollar in those accounts, they haven't been taxed yet. The tax bill, that will come when you take the money out of those accounts. And that could happen in the future when tax rates are much higher than they are today. In this video, I'm going to break down why it's reasonable to worry that tax rates may go up significantly in the future, how RMDs and inherited IRA rules can create a tax time bomb for you and your kids, and how you might take advantage of specific strategies like permanent life insurance and Roth conversions to minimize the amount of taxes paid on your pre-tax accounts for both you during retirement and also for your kids and grandkids when they receive their inheritance. In addition, I will walk through a live demonstration using my proprietary planning software on how we can determine the optimal time to do Roth conversions. My name is Zach Poitra, and I'm a fiduciary financial advisor based in Colorado Springs. I work with households that have saved $500,000 to several million for their retirement and want a clear, tax-aware retirement income and legacy plan. Quick disclaimer, this video is for educational purposes only. This is not tax advice. This is not financial advice. This is not legal advice. Tax laws change and your situation is unique. So before you take any action, talk with a qualified, licensed professional such as myself before making any decisions. Let's start with a big picture. The United States has a very large budget and a continually growing deficit. It also has long-term promises for Social Security, Medicare, and other social programs. Right now, we actually have historically low income tax rates relative to what we've seen in the past. Recent tax law has changed and lowered the tax bracket for many people, but that can change if Congress decides to do so. What that means is there's real uncertainty as to where tax rates will go 5, 10, 15, or 20 years from now. No one can guarantee or tell you exactly where tax rates are going, but it's reasonable if one does the math to come to the conclusion that tax rates will probably be higher in the future. So if most of your savings is in pre-tax accounts like IRAs and 401ks, what you're really saying is, I'll let the government decide how much of this is really mine later. And that's the risk we really want to understand now. And if we can, reduce that risk as much as possible. Let's talk about 401ks, IRAs, and similar pre-tax retirement accounts. First, you don't pay any taxes on that money as you put that money into those accounts. Then the money grows tax deferred while that money stays in those accounts. Now, when you withdraw that money, that's when it's taxed, and it's taxed at the income tax rate of the year that you make the withdrawal. And that means if your tax rate is lower when you pull that money out than when you put it in, then that's a win. But if the tax rate is higher when you pull it out than when you put it in, then you're paying more taxes than you expected or wanted to. And the government, it's not going to let you leave that money in those tax-deferred accounts forever. And that's where required minimum distributions, or RMDs, come into play. Now, RMD stands for Required Minimum Distributions. It's the government's way of saying you can't defer taxes forever. At a certain age, you have to start pulling money out of these accounts and pay taxes on that money. Under the current tax rules, your RMD age will start in your early 70s, depending on your birth year. And once you hit that age, each year, the IRS is going to require you to pull out a certain percentage of your pre-tax retirement accounts and pay taxes on that withdrawal. That percentage of your pre-tax retirement portfolio, that's going to increase a little bit each year, and you will have no choice. You will have to make withdrawals from those accounts, whether you need it or not, and recognize it from a tax standpoint as ordinary income. Some important key points: RMDs only apply to those pre-tax accounts such as IRAs or 401ks, 403bs, and so forth. But they don't apply to Roth IRAs owned by you. And it's really important to point out that if you don't take your RMDs, the penalties are quite significant. Now here's the problem. Imagine if you're living on Social Security, maybe you have a nice pension, and maybe you have a rental property that you're also drawing income on. Then you hit your early 70s and you have those required minimum distributions come along, forcing you to take income that you don't need and pay taxes on that very income. And on top of all of that, that extra income can push you into a higher tax bracket, increase the portion of Social Security income that you have to pay taxes on, and could possibly increase the amount of Medicare surcharges that you have to pay. And if tax rates are generally higher by then, it can feel like your retirement account is getting eaten from the inside out by taxes. Now let's talk about your kids and grandkids. For many years in the past, your kids and grandkids, if they inherited an IRA or a 401k, they could stretch out their withdrawals over their lifetimes, making the tax impact of that additional income very easy to manage. Recent tax law changes have made that much, much harder. Now, the general rule is your kids and grandkids, they'll have to empty that pre-tax account within 10 years of inheriting it. And those distributions that they take are taxed as ordinary income. So picture this: your son or daughter, they're 45, maybe 50 years old, in their peak earning years, and already in a fairly high tax bracket. And then on top of that, they inherit a IRA or 401k from you that's worth $500,000 to $1 million. When that happens, they have to withdraw all of that money and pay taxes on it within 10 years. And this is on top of their existing salary and bonuses. And what does this mean? This means that your kids pay a much higher portion of that inheritance to taxes. And they have very little flexibility to stretch the tax impact over a long period of time. And that's the tax bomb that we're talking about, not just for you, but for your entire family. Now for some good news. You're not entirely powerless. You can't control Congress, but you can control some of the timing and structure of your income. I will cover two major tools to do exactly that. First, there's permanent life insurance, and second, Roth conversions. After I explain both of those, I will take you into my proprietary planning software and show you on screen exactly how we determine an optimal time for those Roth conversions based on your individual situation. First, let's talk about permanent life insurance. Permanent life insurance policies are often called whole life or indexed universal life policies, also known as IULs. You fund these policies with after-tax dollars. Then, when you die, the death benefit, your heirs, your kids, your family, they receive that money 100% tax-free. A lot of these policies, they also build a cash value that allows you to potentially access that cash value later on through withdrawals or policy loans. But the question is how does that help you in your tax situation? Right now, you might have a large 401k or IRA that is a significant taxable asset in the future. And so you might strategically decide to take larger withdrawals from those pre-tax accounts and use part of that money that you're withdrawing to pay the premiums on that life insurance policy. And as I mentioned before, that in turn will create a tax-free death benefit to your heirs. Instead of your kids inheriting a large IRA or 401k that causes them to withdraw that money within 10 years and deal with a large tax bill, they would inherit a one-time tax-free death benefit via the life insurance policy. Now, I do want to point out, though, life insurance has some really important caveats. Life insurance is not an investment account. They have fees, cost of insurance, and limitations. If policies aren't designed and monitored carefully, they can backfire. And also, life insurance, the premiums you pay, they're based on your age and your health. And what this can mean for some people who are in poor health, they might have really high life insurance premiums, making it cost prohibitive, or in some cases, they can be determined uninsurable. Using life insurance to minimize your tax bill for your heirs, it's not for everyone. It's just one tool in the toolbox. But for the right household, permanent life insurance can be a way to convert a highly taxable inheritance into something much more tax efficient for the next generation. Now let's move into Roth conversions, and I'll also show you exactly how we model these Roth conversions using our proprietary planning software. Now, a Roth conversion is when you move money from a pre-tax account like an IRA or a 401k into a Roth IRA. When that happens, you pay taxes on that money that's moved over at the time that it's moved over. And then, under current tax law, any growth inside of that Roth IRA is tax-free. Any withdrawals from that Roth IRA are also tax-free. And those withdrawals will not impact the amount of taxes paid on your Social Security income, nor does it affect your Medicare premiums. And then finally, if you pass a Roth IRA onto your kids or grandkids, they will be able to make withdrawals tax-free as well. Now, why would anyone volunteer to pay taxes sooner rather than later? Well, that's because you might believe that your current tax rate is relatively attractive, and because you think future tax rates are going up, and you'd rather control when you recognize income. Roth conversions allow you to pay taxes at a known rate, reduce the size of your future RMDs, and potentially leave tax-free assets to your heirs. The key, though, is not to convert randomly. You want to fill your tax bracket to the correct level during the correct years. This is also known as a Roth conversion window. Common windows can be the years after you retire but before your RMDs start, years where your total income may be lower than normal, or years where tax rates are particularly favorable. So how can you figure out which years to convert and how much to convert in each of those years? And this is exactly where professional planning software becomes extremely valuable. So with that being said, let me show you exactly how we use software to find the optimal time for converting an IRA to a Roth IRA. Okay, here we are in our proprietary software. In this case, we've got a totally fictional example. This is Mike, who's 60 years old, and Sarah, who's 58. They are still both working. They're not going to retire for a couple more years. And this is the home page for this retirement planning software. As we look at this set of squares or buttons here in the middle, this is where they are at currently at 2025. This button shows both investable liquid assets and other assets. The other assets for Mike and Sarah is simply their home, They have 20,000 a bank account. And then here we have investment accounts, and we have the detail here that they have a regular taxable brokerage account of 800,000, an IRA of 500,000, and Sarah's 401k of 600,000. Of course, since we're looking at Roth conversions, we are concerned about their IRA and 401k, seeing if doing a Roth conversion makes sense for them. This software has a tool called Tax Lab. If I click on Tax Lab, it's going to think for a second, and it's going to make a recommendation. And this is the optimized Roth conversion window for Mike and Sarah, given their current situation. What is recommended is filling the 32% tax bracket instead of just making withdrawals over time. By doing this Roth conversion to fill the 32% tax bracket, they're going to save 8.6% in taxes over time. Total tax savings over their lifetimes is going to be $1.9 million. That will increase their net income $1.9 million. It'll also increase their net legacy by about $863,000, provided they spend all of that $1.9 million. That may be an understatement for the net legacy. Let's look at the comparison between doing nothing and doing a Roth conversion. Well, what does that look like in terms of their tax bill? And then there's a tab here called Total Tax. What it does is it shows the difference between the two strategies. The blue bars are the Roth conversion. This shows how much taxes are going to be paid each year for the Roth conversion and then after the Roth conversion. The yellow bars, that's doing nothing. That's just following the normal withdrawals from the taxable accounts, tax deferred account, and following that order of withdrawals. As you can see, the Roth conversion, the blue bars, are very big at the beginning because we're doing Roth conversions at the beginning of their retirement process. Then the blue bars are very small because all of the taxes have been paid on those pre-tax accounts, and that means their tax bill is going to go down. Now compare that to the yellow bars. Yellow bars, again, at the front end, they're higher and they dip down into early retirement. Then things start to really pop in 2043 or so onward because RMDs start to kick in and they're having to pull more money from their tax deferred accounts just to live on. And so this is a very clear picture as to what kind of tax bill they're going to have to face every year. The other tab I want to show during this demonstration is the break-even point. And this is really important to consider because the break-even point on a Roth conversion in this particular case isn't until 2049. If I'm reading that correctly, 2049. So that means their break-even point is more than 20 years out. If this couple, if they're both healthy and they have a history in their family of living a long time, then waiting 20 years to minimize their tax burden probably makes sense. If only one of the couple is healthy and has a history of longevity, it makes even more sense because they will have to file as a single person once that first spouse dies. This Roth conversion can really make a significant difference for that surviving spouse. Now, if both spouses are not healthy and don't have a history of longevity in their family, waiting more than 20 years to hit the break-even on a Roth conversion may not make sense. There's one situation that it may still make sense, and that is if this couple is very focused on maximizing the legacy that they leave to their kids and grandkids, then a Roth conversion may still make sense. The kids and grandkids, if they inherit a pre-tax account like an IRA or 401k, they only have 10 years to make withdrawals and pay taxes on the money that they inherit in those accounts. And 10 years really is not a lot of time to make withdrawals. Those withdrawals are going to be significant and could really impact the tax bill for the kids and grandkids who inherit those types of accounts. Now, there's just one more thing I want to show you, and that is the tax strategy heat map. This goes through, I'm estimating like 20 different scenarios as to different ways to do Roth conversions, or even different ways to withdraw money from those different types of accounts without doing a Roth conversion. It does highlight the optimal Roth conversion strategy, but it's not a one-size-fits-all situation. Again, there are things to think about like longevity and health to determine whether or not it's worth it to do a Roth conversion. This heat map can be helpful to play around with different scenarios, not just the recommended scenario that the software puts forth. Let's go back to the summary tab. The point here is that Roth conversions can be very powerful. They're not simple, and this is why we use software like this. Software like this removes the guesswork. You can make informed decisions when we work with software that plans everything out on your behalf. Okay, so let's zoom out for a moment. The government's long-term obligations and debt situation make future tax uncertainty very, very real. Your pre-tax accounts, your RMDs, and the 10-year inherited IRA rule can create a backloaded tax problem for you and your family if you don't plan ahead. Tools like permanent insurance and Roth conversions let you reshape how and when taxes are paid, oftentimes spreading the load into more favorable years and more favorable structures. The question is not, how can I avoid paying taxes altogether? The real question is, how do I pay as little tax as reasonably possible over my lifetime and my children's lifetime while still hitting my retirement and legacy goals? If you're 55 or older and you have at least $500,000 in retirement funds saved, and you want to see your own tax time bomb, and more importantly, how to diffuse that tax time bomb, here's what I offer. I set aside a limited number of retirement tax blueprint sessions each week. And in that session, we will load all of your accounts and any retirement income into our retirement software. And then we'll map out your expected income, your RMDs, and potential inherited tax exposure. Then put together and test different Roth conversion schedules to see which years and amounts might be most efficient for you. And then we'll discuss all of the tools available, things like permanent life insurance and Roth conversions, to determine what really makes sense for you in your specific situation. And then from there, you can decide whether to implement those strategies yourself, maybe work with your existing advisor, or continue to work with me if you feel like it's the right fit. If you feel like that would be helpful, there's a link below this video. It'll take you directly to my schedule where you can book a time on my calendar. Now, this first session, there's no charge, but I do limit the number of appointments such that I can serve my existing clients well. Now, my disclaimer again. This video is not tax advice, it's not financial advice, nor legal advice. Before making any financial decisions, please talk to a licensed professional such as myself. Now, if you did find this information helpful, please like and subscribe. And if you know someone that could use this information as well, feel free to share this video. Thanks for watching, and we'll see you next time.